Hello, everyone. Hello, Henrik. Good to see you again.
Good to see you, Jan. Good morning.
So, the idea today is definitely going to be more on the liquidity side of the equation, and giving people a little bit more of an insight in how we're thinking about this last leg, right? Because I think there's a lot of misconceptions out there that we are projecting a more bearish scenario. And I think it is not as simple as bearish or bullish. I think things come in phases and nothing goes up in a straight line, like we always say. So I think it's important for us to focus a little bit more on that and just to clarify some of the Twitter comments that I've been seeing as well. The Q&A session that we're going to do today and part of the webinar is going to be focused on the Fed's cutting phase. So basically focusing on what happens next to the economy and the general markets. My name is Jan Alleman, and I'm joined by the famous Hendrik Zeeberg, and we'll obviously be going through a lot of different topics like we always do. But before we begin, I just wanted to note that this webinar does not constitute any financial advice specifically. Everything that we discuss are personal opinions on the topic at hand. Always conduct your own research and consult a professional before making any financial decision. Participation in this is voluntary, and the information provided is intended for educational and discussion purposes only. So having said that, with no further ado, I would like to give you or hand over the reins to you, Henrik, to maybe start and contextualize the topic that we want to discuss today.
We had the Fed, we had FOMC, Powell coming out Wednesday and telling us that they were going to cut the Fed fund rate by 25 basis points. Seemed to have been one in the committee who wanted to do more, which I, by the way, thought would have been prudent at this point, but leave that aside for now. And well, it shows us that they now starting to realize that, first of all, inflation is not such a big problem, and they also focus more on the labor market. It seems like they are more concerned with that, even though they did not paint a black picture around that. It seems like he was saying, like things like the economy is strong and other things like that. So they don't seem to be in a hurry, and they seem to be okay with the development in the economy that as they see it, which is quite surprising. I would be a little more nervous if I looked at the non-farm payrolls, but they tried to explain that aside why various stuff going on also with migration and so on and so forth. I think that is a very I don't know what to say, but that's the situation. So now obviously what happens next? Because are we then in the blow off top? Are we not? Are we seeing, there are so many people now starting to say, oh, now we have a next 3 to 5 year bull market going on. We have the I don't know, it's called the everything code or whatever it's called by some people also. I mean, all these things. And I think we just should, nail that down and then understand that, as you said, it's not about being, are you bearish now or are you bullish now? I mean, it's like you can be bullish short term, but still being bearish medium and long term. And it's like again, the Titanic hitting the iceberg. It doesn't need that, it doesn't sink immediately. You can see that there are structural damages that cannot be repaired, and that is going to bring the ship to the bottom of the ocean. And I think that moment has passed now, and it seems like we are, to me at least, we now start to see that explosive development. There was one guy also on Twitter asking me, but where's the blow off top? And then you just look at it and just say, try look at it. Since when I started using that phrase in 22 and to the point where we are now, it's more, you had a couple of dips, and then you've been going straight up ever since. That is the very definition of it. That is what we have right here. And I think it's going to go much more crazy in the next few days and weeks here. It doesn't mean that everything is fine. It just means that rotation of capital, also retail pouring in. I think it's very often we'll see that it'll be retail. It'll be the moms and the pops coming in and saying, "Oh, now we see if Meta or Google or whatever, it's going to be moving up fast," and then they'll start putting their hard-earned savings into it, only to understand that at some point that it's right into the top. So I think we are in the phase of that. It actually looks very much like we are well progressed on that, and the Fed thinks that it's in there's no panic there now, and actually we usually have the saying Goldilocks phase, and this is not the Goldilocks phase in that sense. It is actually in Goldilocks phase in the sense that the Fed is not too panicky, because if they had come out and said 50, it could have been a problem. So now they came out with 25 basis point, and people say, oh, they have in control, and things are fine. So that's why I think you'll see that things can move up quite strongly here until the moment where it becomes apparent that things are not so great.
Absolutely. And I think for the sakes of this discussion as well, we'll be touching upon two very specific things. On one side, It's the economy, the business cycle, how the reality of the facts hit working Americans, working class or middle class workers in Europe, Asia, etc. And on the other side, it's this understanding of the liquidity cycle, where, as we've said many times before, the crypto, the Bitcoin crypto combination is the canary in the coal mine to future expectations of liquidity. So it's super important to be able to balance those two concepts within a larger understanding of what a blow off top looks like, what actually is driving that, and also what a subsequent crash and correction actually looks like, and why and how that gets induced, right? And I think this is one of the key things that we want to decipher and we want to present. And I think we're in a unique position to be able to do this because of that variety and expertise. And I think in today's meeting or today's webinar, I will present a couple of things as well using Hawkeye to be able to explore more the liquidity side of the equations, more the short-term things that are now crystallizing or kind of aligning to your Goldilocks point that are indicating more upside within the next 6 to 8 weeks, right? And when we talk about upside, we're not talking about a rampant bull market for the next 24 months, right? I think we're both of the idea that, especially on a risk-adjusted perspective, we are getting to the point where taking chips off the table becomes a prudent thing to do. Blow-off tops are obviously inherently difficult to understand and to test. Nobody's ever been in a bull market and in a blow-off top phase saying this looks like a blow-off top. It always looks different than when you look back on it with 2020 hindsight.
The famous last word was, who was it that said that now? But probably somebody here from the audience could help me. But it was like, we have reached a new plateau of valuations. I think it was in 1929, and it never is, right? So when things go up straight up like in an Eiffel Tower, it always comes down on the other side. So I think it's more about being realistic on that, and then looking at some of the valuations and looking at some of the stocks. I mean, Nvidia is there, Palantir is there, but also just the fact that NASDAQ is up 20, 21, 22 times since 2009. I mean, it's quite remarkable, right? Yeah. So I think it's, again, people think you either have to be bearish or bullish right here. I mean, that's not how we see it. So I think the liquidity part is what can drive things for as long as there is a support in the business cycle. That's at least how I see it, and the business cycle meaning the economy. But there are times where the big wheel is starting to move, and that is when the consumers are not following along. And we may think that the financial world is so important, and we may think there is something about stable coins or whatever it be that can bring in liquidity. But by the end of the day, it's about, can Mrs. Johnson pay her bills? And if she cannot, then it's a problem, because she represents 70-80% of the economy. And the financial world might think that they are very important, but they are not when it comes to the business cycle.
Exactly. And I think this is why that differentiation, I think, fundamentally makes a lot of sense, and is something that we should be exploring further in today's webinar, and obviously in future webinars as we make steps towards that final kind of top, right? Which again, just for our viewers, we want to make clear that we're not in the business of predicting when that happens. We're in the business of being able to identify what key elements are going to start changing or are going to start inflecting into a direction where the likelihood of a top becomes more and more likely. Okay.
Yep.
So having said that, do you want to maybe start with some graphs? Do you have anything that you can show us?
Something I can show you.
Your beautiful graphs that you always show.
You mean my art?
The art, exactly.
Let's look at something that is telling us that we actually do have time. So instead of just being so bearish all the time, then let's look at something that tells us, well, there is actually still some time, because one of the things we would expect to see happen when things are starting to unfold is actually that the credit spreads. So it means that it can be credit spreads on bonds versus so private bonds, or the company bonds versus the government bonds, and so on and so forth. But this is one thing that is important, where we see that all of a sudden, if for as long as the spread goes down, people are not fearing that they could lose their money on what is maybe a little more risky investment, and we can still see that is actually still rather low here. I may have technical perspectives on this, that we could see that this is actually maybe putting us in for something that could explode very, very fast to the upside, which could suggest a black swan event. And we saw some, we have a lot of things out there that can go wrong. We still have a Japanese situation, I think. But there can be things that can all of a sudden happen. It's not normally what happens, but it could, suggest that that could be the situation this time. But this suggests, at least for now, that we have to say there is, the waters is calm. The sea is calm. There's no big storm right now here in the financial market. So that shows us also, okay, for now we can still be, at ease,
Could
at
I
least
just
based on this.
interject? Could I interject one
Mhm.
thing just for the viewers that don't know what we mean by credit spread? So the credit spread, what we're specifically talking about here, is the extra money or the extra yield that investors demand by holding higher risk junk
Yes.
bonds, right? So basically, corporate bonds versus the safer, higher grade government bonds. Okay, just to make that clear.
Yeah. Sorry
So when
about
you
that.
have a
Yes.
widening
Correct.
when you have a widening spread, it means that there's something basically they're demanding more yield because they're seeing inherent risk, right? There is
That's
a
not.
so you want spreads to be tight, right? Where kind
So
of
when they move up,
yeah,
when they
exactly.
start to move up like here, or when we saw it into the .com, also we see them move up here. That actually tells us that things are starting to develop. As you said, people are expecting or wanting some kind of risk premium on actually taking on these riskier bonds, and we see
Yeah.
that is not the situation right now. And that is one thing I have to say. For now, we need to observe that, and I will not call anything of any crash or top or anything like that unless we see something happening here. It may happen really quickly, and that can be due to the complacency I think we have in the market right now. But that is one thing we should absolutely be looking at. Then we have, let me see what else we got in terms of here. Yeah, this one here. And this is the one that I think is starting to show something that, again, all the ones saying, well, we have a 5-year bull market ahead of us. Remember, when we get closer to a recession, short-term yield starts to drop. This is the 1-year yield we got right here. And we've been bouncing off of this neckline for some time, and now it seems like it starts to drop here. It may bounce back up again. I cannot say that. It could do this, but it seems like this is dropping right now. We see the momentum of it, and this is what is important. This is what I think some of the from the financial world do not really understand. That's why we need engineers also into the financial world that can tell us that momentum is important, especially when you have a species like the financial economy and the global economy. When there is a certain momentum to things, you don't just change it by the Fed sprinkling a little, salt and pepper on top of it. It's really about the big machine, and we start to see the short-term yields dropping here. That is a warning sign, and it's especially a warning sign if we can when we see that. Let me just put the unemployment level in as well, new pain here, and especially when we put the unemployment level in as well. We can easily see what's going on then. I mean, the economy was weakening here and we saw that the unemployment level was starting to move up. And yeah, and even here it was actually starting to weaken. But anyway, you get the picture here as well. It may not have happened as fast this time as we've seen in previous times, but we also have to remember that people actually got a lot of stimulus. Everybody got a stimulus check in their hands after COVID. So everybody was kind of bolstered up for the for some kind of headwind. But that savings has now gone. And now we're looking at the employers actually saying, "Oh yeah, do we actually need this amount of people in the workforce?" And that's the next one we can look at and say, for as long as they keep people in and they don't fire people or lay them off, well, that's that. Then we can say that things are okay. But the problem is, if they cannot find work for them, they will, eventually start to lay people off. And if you look at the capacity utilization here, you can see how we into the recessions we've been down at, when it starts to come down, they have to start cutting people and you get the recession. That's how it works. And we see now we at 77, 78% capacity utilization. That is not high. That is not a time where people where the businesses should start to say, oh, we just need more people. Let's just hire some more in. In fact, they don't. And that is why we see also that the open jobs, if you look at the JOLTS, and this is where so we look also that's why we see the open job openings here are actually dropping more and more. And you can say, yeah, but we just down here where we were in 2018. Yeah, well, that's correct. But there's nothing telling us that this is stopping by now. And especially if there is an overcapacity, why would the businesses open more jobs up? So at the same time, we see that there is so much, when it comes to the consumer that there is delinquencies are moving up slowly, not everywhere, but it's slowly moving up, and the unemployment level is absolutely moving up. So, and I think also as just getting back to it, then but the S&P is telling us the real story. I don't see that. I see it as the S&P is in a traditional bubble, financial bubble, based on AI and crypto talk and all of this. And if you go back and you look at all the the bubbles you had through time, 1840, 1920, 2000, and so on and so forth, you will see every time it was around a technology that was introduced. So when a technology comes out, people think, oh, now we are, it's we were such a modern world. And then you have the disconnect between the financial market and the real market. And the real market, Mrs. Johnson there, sitting there with her inflation that she's been seeing, the level has come up, that hasn't moved down. She hasn't lost her job just yet, but she finds it more and more difficult to actually make ends meet. And that is the problem. And that's the real world. This is the financial world. And these are the ones talking about a 2 or 3 or 5 year bull market. This is the real world. And this is the real world. So I think the Fed, when they go in and they look at this, they are, I don't know, it seems like they're not really understanding the what's going on. Because if we look at let me just see if I can remember it. I can talk and let's see. Yeah, there we go. If we look at what we have here, looking at the Fed, and they're doing their 25 basis point and talking about inflation. That's another thing that is such a misconception. Inflation at 2.7% and talking about going up. Look at this, guys. This is going up. This is the rise that people are talking about. It's nothing. This was uncomfortably low for them. We don't like inflation to be lower than 2%, much lower than 2%. This was the level we actually also saw in September of 2007. And inflation moved up into the recession. Why? Because you see, inflation is what is called a lagging indicator, and that is because there are purchase prices, and then it's on stock, and then it goes through the whole value chain or the whole supply chain. That's why inflation can take a little longer before it actually starts to dip again. But the problem is now that the Fed is looking this ridiculously 2.7% and thinking that is a problem, even though inflation was up at, I think it was almost about 5%. It was 5.6% into the financial crisis, where inflation was not the issue. It's only because it lags. It comes later. So the effect comes later. So if the Fed is too hawkish right now, which they are, by the way, and also the same into the .com here, and they do not understand that this is about the consumer and the consumer confidence, which is in the gutter at this point. I mean, if we look at the consumer confidence here and unemployment, well, then you can see that when consumer confidence starts to drop, well, this is inverted for the unemployment, then unemployment rises. It's been that, and it's the consumer that drives the economy up and down. And right now, the Fed is, sorry, my French is so freaking arrogant to talk about a great economy at a time when the consumer confidence here is at rock bottom. I'm not sure Mrs. Johnson is agreeing with him. And so this is, as I see, so the 50 basis point, excuse me, cut would have been prudent here, because we all know that even though unemployment level is a little higher now than it was in 2007 in September, the Fed fund rate was also a bit higher, but the development in non-farm payrolls here as well have been equally as bad. So, and they were late in September 2007. Why 25 basis point? So I think they are really not on top of their game. That's my thesis anyway.
Yeah, I think there's a point to be made here on a general fallacy that exists in markets, and I think in general, kind of as a life principle, right? That people tend to overestimate what you can do in 1 year. They tend to underestimate what they can do in 10. And I think this is as true for measuring effects, right? So we always have this discussion around AI tariffs, right? Which I think are short-term deviations to a underlying structural phenomena that is going to happen no matter what, right? And you can have an argument about tariffs and AI accelerating or exasperating a process that is already in place, right? It's not like AI and tariffs are creating this out of nothing. I think the problems that we are seeing with unemployment, consumer confidence, there are things that happen over many, many years, right? This is a problem that has been coming, I think, probably ever since 2018. And we just don't talk about 2018 as much anymore because of the fact that COVID happened, and because of the fact that we've papered over massive cracks that are still very, very much there, right? If you can even go the route of talking around the quality of jobs, right? Which is obviously a much more subjective metric.
Right.
But it's not just about the number of jobs, so it's the quality of jobs, right?
Correct.
This is a problem across the board, especially when you talk about the influence of AI, right? So yes,
Yeah.
AI is clearly a part or in part responsible for a reduction in job openings because you can be more efficient with the same amount of resources. But
Hmm.
that is not the case with everything. That is not the case in
Hmm.
production. That is not the
No,
case in
no, no, no.
high end and precision types jobs where AI still is hallucinating, creating deviations that have to be double checked and triple checked, right? So
Yeah.
this is not a general phenomenon. I think it will
No.
become more of a general phenomena over the coming years. But these changes don't happen that fast, right? Especially
Hmm.
not on a global level. I think it has to do with culture. If you compare, for instance, Italy and maybe the general kind of average European tendency to adopt technology versus the US, there's
Hmm.
massive deviations there, right?
Yeah, yeah, absolutely. It takes
Right?
time, but it also takes time, for people. I mean, I'm 50, and I can feel the pressure from young people coming in, understanding things much faster. I think I'm pretty okay with following up on it. I actually use AI on a daily basis, and
Yeah.
but I can understand other 50 years old, 55-year olds who have not been sitting in front of a computer and using technology on a daily basis like I have for the last many years,
Yeah.
and then all of a sudden being met by the demands that, hey, oh, by the way, and just the whole digital age, just using this, the iPhone or the phone is something that can be a step for a lot of people. And so that is also why I think as you said, there's a cultural thing, but there will also be a disconnect simply to people that are a little older, the older generations, to actually adopt
The World
this
War II
technology.
generation, right? Yeah.
Yeah, and even I think we just look at the generate, what am I, X, right? Is that what I am? I think it is.
I don't know. Old. That's all I know.
That uh,
Prehistoric.
prehistoric,
Prehistoric. Yeah.
yeah, yeah, I remember the Second World War and the
Exactly.
First. No, so I think it's the technology adoption is not just something that comes; it requires real people also by. And again, it
Yeah.
will not. And we also have to differentiate between something, as you said before, that can change, that will completely change the world in 10 years, completely change the world in 10 years. And just think about it also with the internet. I mean, by at 2000, year 2000, how many was active, doing their whatever purchases, clothes and whatever on the internet. And then by 2010, I think I did most of mine by 2010 at that point. So things in 10 years can really, really shift. And I think we see the same with AI here. It's going to get a leap in productivity. The problem is, and this is what people need to understand, the promise and the outlook of technology is not a guarantee of returns. And you can just ask the investors of the 1920s bubble, the 1840s bubble, and the 2000 bubble about this, because they thought that they could invest into something, and all this technology was just going to make things keep going up. And they learned it the hard way. And now we have a new generation, and the oldies here can then sit and say, "Oh, we've seen this before." And I actually would encourage people to study uh, the whole sentiment around that, and then think it's not like history does not repeat itself; it rhymes, and his rhyme here is just so good that is
Yeah.
so clear.
Let me actually interject a question here because I think it's a question that came up for those of you that sent us the questions beforehand, before the
Yeah.
webinar, and it's a question that just came up through the feed as well. This question around silver and why silver isn't moving in the way that gold is. And I think I'll just maybe start with two topics that I think are relevant to discuss. I think one is that we're dealing not only with a decoupling between expectations on the asset side versus economic reality, but I
Hmm.
think it also has a lot to do with the underlying trust that people have in the system and the specifics around the trust that has always been there, especially in my generation. I grew up, I was born in 91, right? So I grew up in a environment where the underlying understanding of using the dollar as a common denominator for world trade has never been questioned. This is
Hmm.
the first time in 20 odd years, right, where I've for the first time really have had to really think about this, right? So what is the
Hmm.
dollar? How does the dollar fit into the trust in the Western system, right? And I think the gold in a lot of ways is counterbalancing the lack of trust in the underlying dollar, right? And that's probably also the reason why gold is deviating from all the other industrial commodities, right? Like things like silver,
Hmm.
copper, which are a lot more linked to industrial demand, right? Even though there's less supply of silver, it's a lot more linked to that than it is an actual store value, an actual monetary value when you actually start losing trust in the underlying system, right?
Hmm.
And for those of you that actually want to dig deeper into this, read up on a thing called Gresham's law, which basically talks about how good money always crowds out bad money, and there's always one winner, basically, right? So if you have the option between Bitcoin, Ethereum, or gold and silver, you're always going to choose to save and hoard the more valuable thing, and you trade the less valuable thing. And I think in this specific case, it's an extension of that in terms of how that also relates to industrial demand for these underlying materials.
Agree. I think if we look at it from again 40,000 feet here, that it's we did see a significant bottom in 2020. And I think this was I said it before also. I thought I was one of the inventors of that term, but I was not. That we had what was the inverted-Volcker moment, or the inverse Volcker moment. And what do we mean about that? So Volcker was this central bank or the Fed chairman back in 1981. And he hiked rates to the degree that a recession, he kind of, introduced a recession just to bring down inflation. And he did that successfully, and he broke the neck of inflation, inflation expectations, especially. And this is the word, expectations. Because if people start to get it built into their backbone that inflation prices can actually move up, that is actually what starts the cycle of moving that up. And by 2020, when everybody was panicking into COVID, and we had a situation where people couldn't go to work because of the restrictions, and then you ramp up demand. I mean, it's the first lesson you got in economic studies. First, supply and demand. So people go home. Why do I say all this? Because I think that was a shift. I think this is a shift that will be looked upon like we do now in 1981, and thinking this was the shift when we went from an deflationary period, when inflation and people are expecting, oh, there's no deflation. Why would there be inflation? And it just, inflation pressures just kept pushing lower. Also because of the globalization and so on and so forth. Now we see a shift there. Globalization-wise, supply chains are now changing again. And we see then also expectation of prices actually being able to move up. And we have been printing all this extreme amount of money that all of a sudden might start to circulate, which means inflation can move up. And this is the new world. This is the new setup, and I think that's going to change a lot for a lot of people here. So I think the framework there, I mean, is simply not to underestimate the importance of this moment and what we're starting to see. Doesn't mean things will just keep going up, but I think that what we've seen with silver and gold, precious metal, is the expectation of that, or actually that we are going to see now inflation moving higher, and that's why also gold and commodities will move much higher. And the move of commodities out of that bottom in 2020 was actually, I think, the first leg in a massive commodity bull market. That doesn't mean that we go, as we said again, nothing moves in a straight line. We go up and we come down quite strongly, which may be in a deflationary phase. But if I'm right on the stimulus that the Fed, or everybody knows that the Fed is going to come in if we get a bust, well, then the trigger of what could be an inflationary period or longer could be what the Fed is going to do next year. And I think maybe silver and gold have been front running all of this and starting to say, oh, we got inflation coming, hence we need to be ready for it. And maybe people have been front running it a bit too much in the current environment. I think they are right, but they are early. And I think that is and people say, yeah, but Henrik, it's up at 3,700. It's just going to keep going to the moon. Let's see. I think the dollar is going to go to 120 on the Dixie, and I think it's going to crush it quite hard. And I think that will be the real buying moment. But yeah, it's probably a front running, I would call it, of a real development that is coming down the road.
Yes. And it has signs of being a bubble for exactly that point, right? Where it's driven by a sort of mania as well. That is, I think, in a big way driven by a distrust in the underlying generally accepted system of the dollar. We've seen now, I think, with numbers that have come out of China. I read an article about 2 days ago that showed that the actual real demand on Chinese actual gold exchanges was 10 times higher than what was reported.
Yeah.
Right. So there's a frenzy there that is fueling this. And I think in a big way driven by rationality, right? And you always have to remember that what is rational to the individual investor becomes irrational when you look at the collective, right? If everybody, like in COVID, if you go and buy, for a pandemic, right? You go to the supermarket, you buy water, toilet paper, pasta, whatever. That's a rational response, right? But if everybody does that, all of a sudden you have massive shortages, massive mayhem that kind of propagates through the supply system or the supply chain. And I think this is basically what we're on about with gold. And I think there's a clear delineation between how that has been driving gold's price versus silver. I think silver has a lot of a very different structure. Maybe you can talk about the underlying TA structure, Henrik, if you have the graph.
Yeah,
But
I
it
do.
looks different. It does look different,
It
right?
does. It does
Yeah.
very much different. I mean, that's no doubt about that. Let me just see if I can find the S&P 500 and the. I'm actually looking at. So if you can just sing a little song while I'm finding it, Jan. No, so I think we mentioned how we talked about this the last time also.
And also to this point, as you find the graph, there's a question about like what is it that you hold in a recession? I mean, it really goes back to dollar being king, right? So
Yeah,
we're in a phase now where everybody is undermining the dollar, right? And
yeah,
that's again going to the concept of everybody overestimates in 1 year, underestimates in 10. It takes a lot of time for people to wean themselves off of a well-accepted system that they've known for 20, 30, 40, 50 years, right? So we're talking
yeah,
specifically after 1990, which is really the, let's say, the Bretton Woods, the Plaza Accord, sorry, post Plaza Accord, right? Which is
yeah.
really what we're specifically talking about post Bretton Woods in the 1970s, right? So we're now basically questioning a system that has been there for the last 45, 50 years, okay?
Yeah,
And that
well,
is going to
actually, even
bring,
more. I'll say
or
even back
even
to the
longer,
Second World War. 1944 was the Bretton
for
Woods,
sure,
right? And then
for sure.
you had the first blow, and this is actually what we can see here in the chart.
Yeah.
As you talked about, we are seeing that. Let me just explain first what we see here. We have the SPX, so the S&P 500 versus gold here. So we actually take the dollar out of the equation here. And if you say you want to be in either even stocks, or you want to be in gold, well, in 1929 you had a bubble bursting, and there was a distrust in the stock market, and that's why gold actually had a good value there. If you look then to 1971, you had Nixon coming out and doing that Nixon chart, disconnecting gold, or the convertibility of gold, of dollar to gold. And that gave a shock. And we actually saw gold actually reacting positively here, and actually overperforming the stock market for amount of years there. Then we had it up to the .com top here, and then again we had a question on the stock market here was so overvalued, and we saw the decline there after that burst. Now, we actually, I think the everything bubble, as I call it, is bursting here. And I think we both have a 1971 such a scenario, and we have a 2000 and 1929 situation, which were the stock market and the monetary system. So I think we are in a much stronger reason for holding gold here at at the right point. I just want to say that a decline, as you said, because at the moment we introduce the dollar to this system here in a world that is soaked in dollar debt. You're not just going to get that out and we just abandoned the dollar today.
Could
And
I
by the
just
way,
interject? Could I just interject just for the viewers that don't know what Bretton Woods is, because I think this is super important for
oh yeah,
general kind of,
sure,
I think, economic literacy, right? It's super important to understand these cyclical impositions and structural positions that come out of big events like World War II, etc. Basically, the Bretton Woods was a kind of a post World War II conference that aimed at global order and stability, basically putting the dollar at the center, where they basically pegged everything against the dollar, and the dollar was in turn pegged to a gold standard. Okay. And that was basically undone in the 1970s by Nixon. So what the Nixon shock is basically this free floating dollar that was not pegged to the gold anymore, to the gold
yeah,
standard. Okay. So this
yeah.
is the key kind of the key point.
But even that shift took a long time, and we had to understand that this reserve currency we had before that was the pound sterling, and the situation actually deteriorated for the pound sterling from this First World War. Coming out of that, the British Empire had gotten gotten hit by a lot there, not just but especially financially, and that was really what started them to put the question marks to that currency, or to that reserve currency. And then as the Second World War, and the US could stand dominant after having 50% of the production of the world was in the US, 50% of the gold reserves in the US. So the US pretty much sat down and said, well, guys, you know what? The gold, the reserve currency of the world is the dollar. And by the way, we have all the gold here, and we're going to back it by that. And then the misuse of that dollar, of that dominance over the years, but with the Vietnam War, and also everything we saw, yeah, with deficit starting, just simply led to the situation in 1971, which was a shock to the world. And I think that shock is about to get there again. And I'm just, also, I don't know if it has to do with the Fed independency or whatever it's going to come out as in terms of the politics. I don't want to dive into that, but it seems like a shock is coming already. First of all, because of the stock market, and second of all, but it actually shows also here that you can be massively bullish gold, which I am in the long time frame. I think gold can be at $35,000 per ounce in 10 years time. But I just don't think I want to hold it here now, especially if I first of all if I introduce the if I choose the dollar into it, but also if I just look at the gold versus Bitcoin, for instance. And this is where I think Bitcoin even, well, oh, not even, Bitcoin probably looks like it has a much more upside to gold in the short time frame. And this is the difference between having are you bearish or you bullish, whatever asset it is, ask me about the timeline. And the timeline for this would be short term, bullish, very bullish Bitcoin versus gold here. But 10 years out, very bullish gold versus Bitcoin, and also gold versus the S&P 500. So I think this is the important also about when people say you've been so bearish, Henrik, all along, or you've been so bullish, or whatever it is. I'm trying to, tread that and trying to navigate people's understanding that you can be bullish short term, medium term in a certain asset, and then it shifts. But the movement is there. And when you look at something like this, for instance, Bitcoin and gold here, I mean, this is a classic setup for something that is going to reach a top, maybe somewhere up here. And then you have a divergence on the strength of it, which means that even though it's going up, then the strength of that move is weakening. So come here, I think we're going to see a large top in the ratio between Bitcoin versus gold, which means that I would at least say I'm bullish Bitcoin versus gold now, but I'll be bearish Bitcoin versus gold at this point. And this is the shift. This is how we need to understand. And this is probably somewhere these mainstream economists who do not use technical analysis, they do not understand, but how can you be both? And where will you know that the shift is? Well, this is what the technical structures are there for.
Absolutely. And I think this also goes back to the general question of stimulus, right? I saw a couple of questions that also came through asking about, does a stimulus kind of avert actual recession? Like, how does that
Mhm.
actually play into the equation? And I
Mhm.
think there's basically two sides to this, right? And I think the reason I'm mentioning is that I think it ties into the question of Bitcoin and gold and the trust in the system is that you always have different levels of trust and how people perceive value, depending on if it's a positive or negative cycle, right? When shit starts hitting the fan, everybody reverts back to the thing that they know, and that is still the dollar. Like we have to understand this. Nobody's
Yeah.
going to be running to the yuan or to the
No.
Russian ruble, right? And the
Or
question is
even to the
always,
euro.
exactly, even to the euro. Like the question is always, it's always a relative question. When people talk about they don't trust in the underlying dollar system, the question is always, okay, so what is actually going to replace that? Is there a system in place today that actually is better on the fronts that are basically being questioned on the dollar side, right? And I think this is absolutely not the case. I don't think there is a system that is in place that is able to actually solve the issues that are being pegged on the dollar. And I think that again reverts back to the underlying question of, okay, what do people do when they are scared, right? When things are not clear. And I think that is the dollar at the end of the day, right? And stimulus on that front is never gonna paper over the cracks. I think what people misunderstand as well in the COVID crisis is that it wasn't necessarily only a supply side effect. We always have to remember, people talk about like the checks that people received in their banks. That wasn't the thing that created inflation. What created inflation was, I think, a small or unknown thing because it was massive. So it's very interesting to see how misinformed some people are on this front. It was a thing called the PPP loan. It was basically short-term loans that were given by the government to people that had businesses. There were a lot of
Mhm.
fraudulent businesses, and even if you look at, maybe you have the graph at hand, if you look at the number of businesses that were created during the COVID crisis, you'd be
Mhm.
surprised at how big
Yeah.
that number is. Okay, so there's a lot of zombie companies out there that basically front-loaded all of that stimulus. That stimulus went into the real economy because a lot of these fraudulent companies, basically the owners of these fraudulent companies took those loans to invest into the stock market, to buy cars, buy real estate, etc. And that's what actually created the actual inflation. So it wasn't the fact that the Fed was in an easing cycle in itself. It was the direct injection into the economy through these different mechanisms.
Correct.
Okay. So the underlying point to the question, the stimulus, it depends what type of stimulus and where that stimulus is going.
Yeah, but let's also focus on, because that's one of the things. I put a video up here the other day on Twitter, or on X, sorry. And we have these what I call the liquidity tests. that seem to think that, when the credit cycle starts to move up, then you'll have that the business cycle moves up. And then they come up with this chart here. That's something that's been posted also in Financial Times. This is a year old or something, and I think it's been moving up somewhere up here. What people need to understand is that it's not liquidity that drives the business cycle. Business cycle actually drives liquidity, also because we as human beings are part of creating liquidity by taking on loans and so on and so forth that we create. I mean, if I have $1,000, then and I want to spend 2,000, then I go down and I borrow $1,000 in the bank. I mean, all of a sudden there are $2,000 there, but actually there is only the 1,000 there. So we are part of that, and the more I want to spend, the more I want to take up loans, the more credit can also be there. So it's actually not just the central banks. It's not like they come out and say, here is the M2, guys. The M2 is created by us. And if we start to get, I don't want to take on an extra loan because I can see I might get fired, or at least I'm in risk of it, then liquidity may also decline. And this is what the Fed then tries to counter through all there. But they do not have like a switch where they can just put liquidity in and then everything will be fine, because it has to go through the banking system. And that's how it all works. And there is a lag to it. So even when things are starting to move up, global liquidity, like we see here, start to move up, and the Fed, central banks, and so on, they start to stimulate, it takes a while. And you can see it can go up strongly here into 2001, and the recession still began. We had it here in 2007, even more. It bottomed out in 2005, actually, went up strongly here, and the recession began just close to 2008, which is here. And then you had also the same thing, and you correctly said before, Jan, it was a slowdown already from 2018 on. COVID was not just something that fell out of the sky. It actually was very clear, and our business cycle indicator actually also gave that crossover before.
And reverse repo. There was a reverse repo crisis in October 2018, where we were actually, I think, probably a hair away from actually going into a recession. Very, very little known fact.
Yeah, but we correct. That's you're a macro guy as well. No, so the liquidity will not, I mean, this is not the magic thing that can just sprinkle over it. And again, as I said last time also, it's about our willingness as people to take on the debt. Because if we don't spend the money we save on when the Fed now is cut by 25 basis points, which will mean think about it, guys. How many of you have actually thought, okay, now the Fed cut by 25 basis points, you know what? I'm going to buy that new car now because now I can save money on it. That's not how it works. It works really, really slow. And that's why it's like rearranging the deck chair on Titanic in a setup where people find it difficult to put food on the table, and you also have customers' sentiment down the gutter. So it's like honestly, I think it's a little arrogant to sit there and think, and say, we can just sprinkle a little over here and then it'll all be fine, and not looking at the real cracks in the economy. Liquidity cannot solve a solvency problem, and it cannot counter the effects of a massive, gigantic bubble, which we have right now, bursting at some point. And when it does, a lot of money, real US dollars, are going to be soaked out, and that is going to create that effect we're talking about in a deflationary system. But as you can see, that can easily happen within this, even when this has been moving up quite long. Liquidity can be stimulated for a year, 2 years, and so on. Doesn't prevent recessions. It never has, and it never will.
Yeah, it obfuscates, right? It's kind of the chart that you showed there is from cross-border capital, which I think they do make a lot of interesting points, especially on the long term. I think on the long term credit cycle, kind of to borrow some of the concepts that Ray Dalio proposed in his one of his big theses, right? Which is basically this interaction between long term, short term credit cycles with the actual business cycle, right? So there is a kind of a weighing function that basically dictates what actually becomes relevant short-term versus long-term. And I think there's a lot of things that go into that, right? So I think inherently macro is a complex system, right? So it's never one thing and nothing else. It is always a kind of a delicate balance between different factors that kind of amalgamate into something that we basically define as the business cycle, right? It's kind of the average sentiment, the average way that people perceive the economy, right? If everybody is getting laid off and has a negative perspective on the economy, of course, businesses are going to feel that, right? They are going to see, stockpiles go up. They're going to see their investment, so their actual capex investments slow down because they have more inventory than they expect, right? Which then has an effect in how they reduce prices, which in turn becomes deflationary. So there's a lot of different pressures that come from consumer expectations and how businesses perceive that, right?
Yeah.
And how they balance market share versus growth, right? And I think we have to take all of these things into consideration. I think what we're trying to kind of decode in these webinar series.
Right.
Maybe on the point of liquidity, because I'm seeing a lot of questions coming through that deal also with crypto and general liquidity. Do we want to maybe shift
Sure.
for a couple of
Yeah,
minutes
dude.
into
Yeah,
that front?
absolutely.
Let me
Let's do
just
that.
open up. Let me
And this has
just
more to do
open
with the
up.
short term, what can we expect now? Because I think in the bigger picture, nothing has changed with the 25 basis point cut. We still seeing we're going that direction, but liquidity wise, and this is where our framework will help us a lot,
Yes.
is telling us that we still have a great market in front of us. So even though the Titanic is right there on the iceberg, but
So
let's look into
this
that.
this is what makes, I think, Hendrik's analysis together with our analysis as well, in terms of kind of what you would look at as a kind of a liquidity analysis of crypto, very relevant, right? And that's very a misunderstood component of looking at macro liquidity, right? So it's not like we look at crypto and say, oh, crypto is going to go up or down. We always want to weigh that versus the liquidity expectations within the general global macroeconomic system, right? That's why we use the word canary in the coal mine, because it really is the most sensitive thing to future expectations of liquidity. Now, what does that mean in the general sense? So we're seeing, for instance, a lot of things being said. There's like, the extremely bearish factions on Twitter that are driven more, let's say, by the Dr. Profit, these types of very renowned, and I think people that are, very educated and very good at what they do, but that sometimes misunderstand the effects that take hold and they kind of become dominant in the end of these macro cycles because of the fact that things become irrational. If you look at
Yeah.
them purely from a TA structural perspective, they don't make any sense unless you actually allow for the understanding of what a blow off top can actually look like when liquidity conditions are ripe and actually driving the behavior, right? So on that front, I wanted to start with the three graphs that we presented as well
And
the
it's
last
back to
couple of
the old
times.
saying: the market can stay irrational longer than you can stay solvent, and that is actually
Exactly.
it. And Michael Burry was the perfect example in the financial
Yeah.
crisis. He was right, but very early, and but that's where liquidity can help for a long time.
Exactly. And I wanted to maybe start with this graph here. So I'm sorry, I'm still having issues with my x-axis, but what we're looking at here is basically beginning of last year up until today, right? So this is basically up until September 16th. So it's roughly about the same. Liquidity, especially money inflows and outflows, they don't change on the flip of a dime. I'll interject one thing because there was a question that came through Twitter, and I think I just saw it as well on the chat, with people asking for why some of our Twitter posts are deviating from Bitcoin Vector Lite and some of our Bitcoin Vector liquidity analyses. And there's basically one key reason for that. So what you're looking at here, and what Willy Woo does extremely well, I think he's world class at this analysis, is measuring the amount of actual dollars entering the system. And what we basically do is that we take that over a prolonged period of time and we normalize those flows. Because I don't just care about the absolute number of dollars coming in, but I care about the absolute number that comes in versus the actual price, right? Because it takes more energy to move Bitcoin now by 1% than it did 10 or 15 months back. Does that make sense? So there's always a relative marginal rate of increase that matters, not only the absolute rate. Okay. So what we're looking at here is the actual dollar amount that is coming in, and we normalize that towards an index. What you see when we talk about the fundamental side of the equation, so network growth, liquidity within the Bitcoin fundamental index, what we're doing there is that we're measuring the activity that happens within the ecosystem. That takes into account as well the money flowing in, but also the amount of interactions that are happening within the ecosystem, right? So is it very prosperous? Are a lot of people interacting with each other, or is that interaction going down? And this is important because it gives us an understanding on the actual velocity of money within the system, right? So it's not worth anything to anyone if everybody is rich but nobody is interacting with each other, right? For an economy to flourish, and Henrik is probably at the forefront of being able to explain this on a minute level, for an economy to be able to propagate and become like to actually flourish and be robust and to grow, you need interactions. You need people to exchange, right? If you look at the fundamental building block of an economy is the exchange of goods, right? That's at the minute level the case. And when you start adding all of these different exchanges together, that's how you get the overall economy, right? It's a concept that I think was explained super well by Ray Dalio in his, I don't forget what the name of the video was that he posted online, but if you type Ray Dalio economic system, you will find it. Super nice explanation for those of you that want to dig a little bit deeper. But the point being that these are two different things. So we could actually maybe change the name slightly and we can call it liquidity interactions, or I can maybe, if you have any proposals, please write them into the chat. But they are basically measuring different things. So what we're looking at here is the amount of capital coming into the system. And you see very clearly that on Bitcoin side, this has been fundamentally different than what we saw in November and February of last year. February and November of last year, Bitcoin was the gateway to crypto. You could not basically invest into crypto if you were not going through Bitcoin, right? Especially on an institutional level. You had very liquid ETFs, and all the different on-ramp and off-ramps were very liquid and had a lot of volume on Bitcoin and Bitcoin pegged instruments. That is not the case anymore, especially since the narrative started shifting on the traditional finance side of the equation, started shifting towards Ethereum. And that is significant for two specific reasons. One, it has changed the dynamic and the importance of the Bitcoin ecosystem as a liquidity mechanism for the rest of the crypto economy. And two, it has created a bifurcation where all of a sudden the marginal dollar that was going to Bitcoin started to move into Ethereum and Solana. And to the same point that I made before, where a percentage move of Bitcoin at 60,000 takes less energy than a percentage move in Bitcoin today, the same is true for Ethereum and Solana, right? So if you were looking at, let's say, an average median rate of entry of a couple of $1 billion a week, right, into Bitcoin, physical, actual dollars coming into Bitcoin, if all of a sudden you're deviating 20, 30, 40% of that into Ethereum and Solana that are significantly lower in terms of the marginal rate of change in terms of the price, that can have disproportionate effects. And that's actually one of the reasons both Henrik and myself believe that we're going to see much more upside in Ethereum and Solana, because of the fact that it takes a lot less energy to move those ecosystems, right? And you see it very clearly here. So here we're looking at Solana, right? And you see that we've had a massive spike in dollars entering the Solana ecosystem, especially towards the end of July. So most of August, we've started to see that massive increase, and it's now stabilized. So as long as that stabilizes up and doesn't drop down significantly, it tells us that the actual move that is happening is being supported by fundamentals. Okay, fundamentals specifically in dollar-denominated flow terms. Same thing for Ethereum. For those of you that asked in the previous discussions that we've had, like how long can that go on for? It can go on for a very long time. If you look at some of the historical inflow patterns in Bitcoin, it can go on for 3, 4, 5 months in certain cases. It can be very, very prolonged and persistent. Okay, so I think this is super important. On a separate note as well, when we start looking at how this actually affects the underlying crypto economy, I wanted to quickly touch upon two things on Hawkeye as well. So for those of you that don't know, Hawkeye is our platform that unifies together the fundamentals and on-chain analytics, liquidity flow analysis, and systematic price analysis. So we're a systematic trading fund that basically has multiple different types of strategies. And we have specialized in understanding basically trend and momentum, right? And understanding how trend and volatility together indicate when true momentum is actually there, right? When you're not just dealing with a market that is just volatile, but is actually underpinned by actual real demand and real capital flows. On a fundamental level, what does that actually mean, what I mentioned before? So touching, again, making the differentiation between capital moving into the system, right, which would be the equivalent of an investment, right? And Henrik has touched upon the point of differentiating investment from actual economic activity, right? Just because a company invests money into something does not mean that you're going to generate a marginal increase in the productivity of something, right? It increases the chances significantly, but it doesn't guarantee it. And I think this touches upon, again, another analogy that we made with AI, where what we're seeing today is not the economic or the productivity effects of AI, but we're seeing the net effects on investments and spending that allow AI to be proliferated within the economy, right? So those are two different things. We're going to start seeing the effects of that for sure down the line. And I think it's going to generate massive growth potential and cost reduction potential down the line, but that is not what we're seeing today. What we're seeing today is the the financial system adjusting to future expectations of massive capex investments on that environment. And it's basically when you talk about liquidity and economic activity, so the index that I just showed before versus fundamentals, right, which is what you're looking at here. So more specifically, if you look at it on a yearly basis, the network growth and the liquidity, it's basically those two different things. What you're measuring with the Bitcoin fundamental index, the network growth and liquidity in a fundamental perspective is you're really measuring the velocity of money and the impact that that has on the economy. So how productive is the Bitcoin ecosystem with the amount of capital that is within the system? Are we efficient? Is that money being moved around from basically sellers to buyers in an effective way? Where is that flow going? Is that flow going towards selling? Is that flow going towards reinvestment, right? Is it being used to actually as a collateral to be able to create more credit, right? As one example, right? There's like many, many different ways, especially now that utility starts becoming more and more predominant when it comes to the discussion around Bitcoin, right? I myself, for instance, in our company, we use Bitcoin as collateral for loans, right? Which is very interesting. Something that did not happen before 24. That is now something that is more and more becoming the norm. And you can see here that we basically have a very similar type of situation that we had in basically the beginning or the later parts of November, December of last year, and more specifically, similar to what we saw in February, right? And if you look at the aggregated version, so the actual economic strength, we're at a very elevated space. That was very different than what we saw, for instance, back in January, right? So a lot of people are comparing what we're seeing now with December and January on the Bitcoin front and saying that this is the top. From a fundamentalist perspective, that is not being supported because you see it here. We had a massive drop off. I mean, this year is unprecedented how big that drop off was between basically late December into the beginning phases of January, and then you had a massive collapse into beginning of February, right? So over a month, you basically had a halvening of the economic activity, to kind of give an analogy, right? Which is significant. We are not seeing that today. Okay. And when it comes to the actual strength of the market, there's another very important thing to consider. Bitcoin is not driving the behavior. We need a strong and stable Bitcoin, like we keep saying, because that is important to sustain the foundations of capital rotation and investments. But since roughly, let me see here, since let's say the beginning of July, it's been an Ethereum and now over the last couple of weeks, a Solana-driven narrative. That's where the strength is. The capital is literally rotating into that direction. We're seeing direct money flowing into that and also capital rotating from Bitcoin into Ethereum and Solana. That's not being reflected in the price because in that redistribution, prices tend to drop, right? Because people sell and you're not getting the buy effect directly, right? Sometimes people sell in Bitcoin, they go into cash, and then maybe a couple of days later, they buy Ethereum, right? So it's not an instantaneous transaction. And I think that's throwing a lot of people off because they're seeing the sell side on Bitcoin, but not an immediate buy side somewhere else. Does that make sense? So these things are delayed in time.
So what you're saying is the rotation is going on. We can visibly see that the
Can
rotation is
visibly see
going
it.
on, which is a psychological, natural thing we see into the final phase of a bull run, both for Bitcoin and crypto in general.
Absolutely. If that is a final phase or not, I cannot say that with guarantee, right? It could be that it
No,
actually goes on for longer than even
no.
this current setup is telling us, right? It could be, and I'll tell you why, for instance.
Mhm,
We've never seen a situation where the rotation from Bitcoin, so from the actual low that we had on April 7th, right? Which was
mhm.
the actual low because we can track that with our aggregated impulse. What's the aggregate impulse? It tells you when the top 350 assets are capitulating, right? And bottoming phases is usually marked by a massive capitulation. A, we're not seeing that, and B, and the reason for it is that the market is not driven by Bitcoin. There's more of a kind of a plethora of different things that are now branching out and that have independent strength. So their strength is not due to Bitcoin, but they have idiosyncratic strength within their own ecosystems because they're being basically supported by incoming capital flows. But we're also seeing the rotation, right? And we've never seen a rotation that has been this strong for this long. I cannot
Mhm,
remember the last time. I think actually maybe in 2021, we had
mhm.
something similar to this.
Yeah, that would make sense because we also had a top there in 21, right? So
Yeah, but even if you look at 21, right? We never
mhm.
had an
This is
Ethereum dominated environment that has been
that
that has
that's long.
lasted for
Yeah,
this long. Yes. And
yeah,
that
yeah.
is important because that's pent up energy. That's energy
Oh
that
yeah,
is
yeah, sure.
being
It's
deployed
pushing
into
it up
Ethereum.
to the next level, and yeah,
Exactly, right?
and guys, I
So
just want to say here,
yeah,
this is one of the reasons also why I'm with Swissblock. So, this is, top of the state of the art in terms of how we look at liquidity. I can tell you. I mean, this is quite amazing what our people have been developing here.
absolutely. And this is only the tip of the iceberg. I mean, our research,
Mhm.
like what
Yeah.
you're seeing here is the state of the art that we had back in, I would say probably late 22, but it's something that has been very robust and persistent, right? It gives us a very good kind of North
Mhm.
Star, similar to your business cycle analysis, that is just
Yeah.
extremely good at pinpointing
Yeah.
when there's those inflection points, right? So that's really what we care about here.
Yeah, and
Really
just
strong inflection
just
points. Yeah.
for, I think
Yeah.
we probably getting to the end of it also here, but I
Yes.
think there's two things. Maybe jump in. Could you just show the success of the algo trend actually, just to show how successful it actually been in getting us in and out and actually
Yeah.
outperforming Bitcoin on the long time frame, which is quite, impressive, right? So maybe just show that, just
Yeah.
for people to
So
understand the framework also.
yes, exactly.
And I
So
have one more point I want to make because and just so I think the one point I want to make by the end of this, also to show one more chart, is why are we not in 1998 scenario? Because that's what some people think we are. We have 2 3 years more of a rally. I want to show that as the last point. But Jan, maybe if you could show that, because I think the
yeah.
algo trend of the success of the framework is quite amazing.
Yes, absolutely.
Yeah, let me show you why, guys. I don't think we are in a 1998 situation. This is the business cycle model that I've developed, and which shows that when people talk about 1998 and the rate cuts we had there, well, that was at a completely different time in terms of the business cycle. As
Oh,
you can see,
got it
this is
running now. Sorry, just got it running. So I'll show it right after.
okay. 1996 is here. 2000 is here. This is the leading indicator. The moment we are starting to say things are happening, we have the structural damage to the hull, is when we see the crossover between the red line and the horizontal line. So 1998 is somewhere here. And coincident-wise, it was something like here. I can't even show you the chart here. I mean, it's simply a bit chopped off here by the top. There's no comparison to where we are now, where the leading indicators is actually already below zero, which is telling us that the recession is going to come. It's been correct 70 years back in time. Every time, no false signals ever. And we're getting closer here. We are not in 1998. This is where business cycle is important. That's why when people come and say, oh, we have a rate cut here, we have a bubble, that's 1998, because that was the time the Fed started to cut. That was because the Fed was actually cutting before we actually started to see a real slowdown. This time, the economy is far more ahead, deteriorated than we were back then. So we are not in 1998 as according to the business cycle. And if you look at the yield curves as well, we're nowhere near that. So just be careful when you read on X there. We're not in 1998. So Jan, you got it.
Yeah, so there's another point for those of you that are still not 100% sure why Willy's macro liquidity analysis deviates. Remember that Willy is very focused on the Bitcoin side of the equation. So, like I showed before, Bitcoin is clearly deteriorating versus other assets, right? And that is usually very indicative of the end, right? Because you need a strong Bitcoin. That doesn't mean that the flows don't come. I think they will because of the way that the macro environment and M2 and all these things are propagating, but they basically tell us that the rotation is happening. And that's usually a telltale sign of the end. And for those of you that actually ask, like, what does that mean in terms of the end? Is it tomorrow, in a week? I think it's a couple of months. So we're really looking at Q4 as probably the likely moment that happens. Maybe towards the mid part of November, could also be end of October. That's the sort of range that we're discussing. Now, remember that we're not dealing with absolutes, right? We're always dealing with probabilities, and we're going to be tracking these structural pieces to our puzzle as we move forward. So we're going to be able to give you that perspective, especially in our vector series, basic Bitcoin vector and altcoin vector, especially the advanced, where we also have some of our alerts that actually give people an update on where things are propagating to. And you're definitely going to know when in those channels when we get closer to that event, or where we are going to start de-risking on a more fundamental level. But for now, we are still in an upcycle. And upcycles, they don't last for 6 months, right? So we're talking about probably a two-step cycle, right, Hendrik, where we now recover, have a correction, and then probably move stronger into the end of October, kind of beginning parts of November. That's what my base case would be right now, given the
Yeah,
liquidity and all these things that we discussed.
yeah,
Um, so to give a quick sneak peek into what that actually looks like. So what I'm going to show you right now is cash and Bitcoin strategy that we use that underpins is one of the major pillars of the basically the Hawkeye framework, and as an extension, the Bitcoin and the altcoin vectors. Okay, so how we make relative decisions on do we have a strong momentum environment or an actual weak momentum environment. For those of you that are a little bit more embedded with how we do things, what we call strategic and tactical environments. Strategic environments, very strong momentum. Things are going very, very strong. A lot of capital moving in. Tactical, indecisive environments, range bound. That's when market makers, right? Kind of when market makers spoof the books, or they kind of push price up and down. That's a tactical type of environment. So what I'm going to be showing you here is how we identify that and what that actually looks like in terms of performance, right? So if you can see my screen here. So this is basically the strategy versus so what you're looking at here is Bitcoin price, which is great. We have the blue curve, which is our actual Bitcoin cash and exposure, right? So you're only buying Bitcoin or going to cash. You're doing one of two things. No leverage, no anything. And you're comparing that against a weighted index, which is the green line, okay? Weighted index of different alts that you could potentially buy. And you can see that what basically makes this strategy massively outperformance to other types of strategies that exist is that it is able to identify when Bitcoin is in that turning point, right? When the momentum is really going out the window and the risk reward in the system starts becoming problematic, right? Where every dollar that you put in gives you less than a dollar when you take it out, right? Which is not a good investment proposition. And when you do that consistently over time, you tend to outperform the actual underlying strategy. Okay, and this is basically what you're seeing here. And I think
So the
that's really the
percentage
power.
returns, so Bitcoin has
Yeah.
generated 515% since 21,
No,
and
that's
our
the
model.
weighted index. So Bitcoin has
Okay, okay,
generated
okay. All right.
since the beginning of 21, when Bitcoin was at
Yeah,
$35,000, it has done
yeah,
roughly a 4x, right? It's like a
yeah.
370%.
And
Or
our
sorry, a 200 something percent, like a 3x.
yes.
What you're looking at here on the right side, sorry, I forgot to explain this. This is a log
Mm,
chart, right? So what you're seeing on
mhm.
the right side is the multiple for every dollar that you would have put in the first day of 21. And if you would have
Yeah.
sold now, you would have
Mm,
done a 21.4x with the strategy. You would have done a 6x with the index, and you would have done a 3.7x if you just held Bitcoin
yeah. And this,
without selling.
guys, by the
Yeah.
way, is something that I mean we get, on a daily basis. We simply get the US update. It tells us, how much to be allocated in one or the other.
Yes.
So this is a massively, this is just a fantastic tool. Just to let you know. All right, Jan. I
Exactly.
think we are over time, and but it was great to talk. You're a busy man, so I always enjoy
Yes.
to have our chats. So thank you for that.
Absolutely. Thanks a lot for taking the time. And for those of you that are not following Henrik, obviously follow him on Twitter. Actually, for those, maybe can we mention the
Oh
the
yeah, yeah,
Sweden
yeah,
thing as well?
tomorrow.
I
Tomorrow,
think
I,
this is massive. So yeah.
yeah, I have a TEDx talk tomorrow. So I'm actually, I was memorizing it while when I went to bed yesterday, the talk. So I have to go through there, and I'm gonna talk. And my opening statement will be, Bitcoin is like a venereal disease. Not my words, not my words. It's the words of Charlie Munger, but I'm starting there.
Okay.
All
Interesting.
right.
So you're for those of you that are interested in that talk, I'm definitely going to be looking forward to it. There's not going to be a live version, right? So this is going to be a recording, and then
Yeah, it'll be a
you know,
recording. I don't know.
yeah.
I think there's this. I need to stay within 18 minutes. So I think there's going to be a YouTube video on that'll come out, and yeah,
Okay,
and
but
then my
we're going to be
and
sending that to our followers, right? Whenever it comes
hopefully
out.
also, yeah, absolutely, and also the book, a book is coming out.
Oh yeah,
So
that's
the what we call the monetary house of cards, the bust of the everything bubble caused by central bank hubris. Is I think it's our designers are just on it right now, and we will will come out soon. And this is where you can actually see a lot of the things that we talk about here, also why and the whole background of things, why we also see these bubbles again and again, and why the hubris is driving the central banks from. Actually, there's a chapter calling "Becoming Demigods," and I think that's what we have seen over the last 25 years of central banking being the most boring thing in the world, and now everybody's sitting there watching it on Wednesday nights, right? So I
crazy,
hope you
right?
will. Yeah. So we'll send, but that'll also be outcome, to come up on our website, and you'll be able to purchase an online version and also a physical hardback at some point.
Yeah. As the last point, it's funny that you said that I'm the busy one. So you've written a book and you're doing a TEDx, and I don't know, God knows how many other big interviews that you have. So it seems like you're the busy one, not me.
Yeah, yeah. But I don't have people administration, Jan. That's it.
Yeah.
You got it.
Fair point. Sounds good. Thanks a lot,
All
Henrik.
right.
And
Thank
thank
you,
you
Aaron.
guys for joining. And yeah, we'll update you guys when the next webinar is going to be. Probably early days of October.
Yes. Thanks.
See you guys.